5/29, 2013. We're approaching the midpoint of the year on the S&P 500. Price volatility, we've been long overdue. All the other professionals have been expecting, 5 to 10% pullback. It hadn't come. And it doesn't come until you get big down moves, you get lower high reversals. Yesterday was 1675. We hit the all-time multi-year calendar year highs. We reversed and the volatility went straight down. That's called bear move. Bull comes back, but bull ran out of steam, and on the 60-minute the S&P is going to come right back down, and we're going to see here where on the 60-minute chart where we had these lows put in the other day, and they went straight right back up and straight right back down. That's how you know when a market's going to correct, because you have to have both price volatility movements working the same way. One of the things I will show here on a daily chart on the S&P is that the S&P is going to test once again at 1639. At the current moment is a 20-day simple moving average on a daily. You can see that the blue line is a 10-day simple moving average at 1657, and that will remain a wall of resistance on the current level as of this date as your resistances. You can see the top here. You can see a lower high reversal. That's what a daily looks like. We got support right around the 1620 area, right here where we had that last little run up. If we break the 20-day moving average, that's this line right here, then we would sell below it. And this line, this red line here, is a 50-day moving average at the current reading of 1595. So if we break below here, the put options for the bear and that correction would be underway. That we are in the middle of the calendar year. The broader equities, the big bull runs that have happened, are finally correcting. What we will be doing is monitoring very carefully of where these stocks that have made all these highs all calendar year, the bears and hedge fund managers that have equities that are short in their portfolio have been very miserable, but now they're getting some get back. And every great bull rally that starts, that went parabolically up, we had every Tuesday for 20 weeks in a row, markets ended up on the high note. So the volatility is here on the S&P, and I will show people what a 30-minute chart looks like on the S&P. Big reversal to the downside, you make money. Big reversal for the bull back to the upside. But now the bull is going to come down in here, and we're going to see who has the most weighting. We still have a long ways to go. This is just a 30-minute chart on the S&P 500, everybody. We're going to be looking at put options on the S&P. We're going to be looking at stuff like this called the SDS. What is it? For a short-term trade, it's an ultra-short S&P 500, and it's finally made lows here. So when the S&P goes down, this little bear move, this little bear ETF goes up in value. So we're looking at these kinds of movements. So when we do get a correction that's been long overdue, and all the professionals have been very dumbfounded about why it hasn't come here. There are a lot of mechanics involved. I'm not going to go involved with it with the public, but all the MMT traders know. And I'll tell you what, if you need buying power, you need trading capital, you need a month-to-month training, you want to make money with these markets, you want to understand what bull runs are, it's time for you to get here. That's the SDS ultra short intraday trade only. Now, when I go back to the S&P 500, I will show you clearly once again that the S&P 500 has not made that move, and that's that bear move right here that I'm showing. So that's what it looks like when you're going to trade a bear ETF very short term for a capital gain to go up and then sell into the move.